Hey guys, welcome back. My name is Leland Baptist. I'm one of the private bankers with Lee-Chandler, and today we're going to talk about a wealth building, okay? Today we're going to talk about how to build wealth. How to build wealth. Now, this is not meant to be a overcomplicated thing. A lot of people try to give you lots of charts and things to make it really difficult, but it's not difficult at all. This is actually very simple. It just boils down to two things, and these are the two opposing words that I have behind me. Basically, it boils down to either liquid or non-liquidity or illiquidity. All right, and essentially what it means is that what type of assets do you want? Okay, so I want to list a few assets. We'll talk about the strategy behind it and how those assets can be very good building blocks when it comes to wealth, because essentially everyone is building their portfolio. And if you're building your portfolio, the key goal there is, of course, wealth. And wealth means that you have the ability to pass assets and or income to the next generation, hopefully your grandchildren's children. All right, so let's get to it. So real quick, let's talk about something that's considered non-liquid. Believe it or not, real estate, as much as I love real estate is actually not as liquid as most people think. Normally, if someone is looking to sell something on the market, contingent to how that particular market is for their subgroup of the United States, real estate is going to take somewhere between, maybe 30 to 60 days. So for real estate, I would say that is actually non-liquid. Alright, now something that is more liquid, of course, is going to be any type of currency. Alright, so that could be, for example, it could be Bitcoin or cryptocurrency. So I'll write in here crypto. It could also be that of cash or gold. Alright, so those are good things that are actually liquid. Something that's not as liquid could be portraits or pictures or art. Alright. We all know that both real estate and art can also skyrocket in value based on whoever is purchasing it or bidding or speculation, things like that. Something that is also not as liquid would be vehicles. Okay? So, real quick, here's something that's very important. When we're talking about building your wealth, we want to make sure we have a strong foundation. And we can use these 6 things here as kind of what our foundations could be. All right. So I'm gonna try my best to make basically like a bar chart, and at the very bottom, that's gonna be our foundation, and the very top, we're gonna have other things there as well. Okay. So we're gonna pretend that this bar chart here is your portfolio, and what we're basically looking for is looking at 60% to be what we would consider to be non-liquid assets. All right. So these would be considered hard assets. And another asset that technically is very easy to be liquid is actually stocks. I didn't put that here, but I need to. Stocks. Okay. Now, something that's important to know is that the more liquid an asset is, the more volatile it is as well. I hope that makes sense. So, the more likely that I can get in and out of something, the more likely that I can trade it or sell it very quickly. That also means that it has a higher probability of having a huge price difference of its value. Make sense? So, for example, cryptocurrency. So we can all get in and out of cryptocurrency very quickly. You have a Bitcoin wallet, so forth. You can exchange it for cash, put on different apps, all that stuff, right? Well, could cryptocurrency plummet? It's possible. Could it skyrocket? Very possible. Same thing for cash. Could the United States dollar crash? Yeah, for sure. Could other currencies throughout the world crash? Absolutely. But could I also exchange those very quickly, like Forex and so forth? Yeah, you can. Same thing for gold. Could gold change it? And so I think you kind of get the gist of it, okay? Precious metals here. Now, if we're talking about 60% as being non-liquid, and this is being our foundation, right? And we're also talking about here is that 40% is going to be quote-unquote liquid. Now, what works best for clients, from what I've seen, all right, is that most clients prefer to have cash and precious metals to be that of their liquid. Okay, so gold, silver, and cash. All right. And in reference to the foundation portion, what most clients end up having is really a lot of real estate. Now, put art here too, because art is very, very common. I don't see a lot of clients with a lot of vehicles or collectibles, but that does not mean that not everyone does it. People do it obviously because it's profitable for them. Now, here's the deal. You can do any of this for yourself. Whether you have $10 in your bank account, you can honestly decide what you want to do. You could buy silver coins for $5. You could buy a piece of art for, I don't know, $5 possibly, right? But the beauty with this is that whatever size your portfolio is, all right, if you're middle income, if you're a high net worth individual, whatever it is, you want to make sure that you have a 60-40 split, okay? The foundation here of it being 60% is really what's going to raise your portfolio's asset level or raise your portfolio's value over time, all right? But your 40% here is going to be most volatile. It's going to have a lot of velocity based on what's going on in that particular market at that time. Okay, I hope that makes sense. So because the markets here for these assets normally move a lot slower, and by vehicles I mean collectibles. Because these assets tend to move a lot slower, then that means your foundation is going to be steady. All right. These assets tend to move a lot quicker, which means that they're going to change a lot. All right. Just as a quick example, if your portfolio was 100% into Bitcoin, there could be a possibility in the future that Bitcoin's price can skyrocket. Without meaning that 100% of your portfolio would also skyrocket. Likewise, let's say that Bitcoin plummets. That means that 100% of your portfolio that's in crypto could also plummet with that as well. All right. But if you have a foundation on something that's more stable, like any of these real assets over here that normally can at least maintain their asset value, then your portfolio as a whole will still be fine. All right. So I hope that makes sense. Like I said, it's a very, very quick video, very, very simple. It's just 60-40, 60% as non-liquid assets, and then 40% as very liquid assets. All right. So that includes cash, silver, and so forth. Okay. Thanks so much. Talk to you guys soon.